want to continue working in chapter 5, a very long chapter, and we want to pick up hobby losses. We want to pick up at hobby losses. And what they're discussing in this section is activities that are engaged in for hobby purposes, activities that we engage in for hobby purposes because I enjoy it and then I may happen to make money off of it, versus an activity that I'm in it for profit, versus an activity I'm in it for a profit. So we're going to look at what do we do if we're engaged in an activity that is deemed to be a hobby. How do we report the income and take the deductions, versus an activity that we're engaged in and we deem it to be, this is really a business, it's for a profit motive. So, and how do we take those deductions and where do they end up? We're on page 525 in chapter 5. And they talk about some operational rules here. Individuals or taxpayers can avoid this hobby loss, and we'll talk about the hobby loss rules if they can show that an activity was conducted with the intent to earn a profit. Because all businesses don't earn a profit, and just because my business has a loss does not mean that I'm not in it for profit motive. And with our economy, we could have a lot of people starting businesses and starting ventures on their own, and we want to make sure that you're hitting those limitations of hitting those requirements to be deemed a profit, so that you can take the loss. What's going to happen if you're deemed a hobby, you're not going to be able to take the loss deduction. On page 5-25, they talk about these operational rules to determine whether the activity was engaged in for a profit. The IRS is going to look at the following: whether the activity is conducted like a business. You know, how do you run the business? How do you conduct the activities? The expertise of the taxpayer. Am I using my expertise? Something that I'm very knowledgeable of. The time and effort that's expended. The time and how much time and effort am I putting in? Do I have a full day job and then I try to do this on the side? Previous success of the taxpayer in similar activities. How well have I done in previous activities in this area? The relationship of income to losses in the activity. The relationship of income to losses in the activity. Financial status of the taxpayer. And elements of personal recreation in the activity. Is this just really for fun and you happen to make money off of it, but is it really recreation? It also tells us that the tax law provides a rebuttable presumption. They have this presumption that if an activity shows a profit for 3 of the 5 years that it's in business, 2 of 7 years if we're referring to horses, then the activity is engaged in for profit. So they're saying that if you have a profit 3 of the 5 years or 2 of 7 when we're dealing with horses, then the IRS is going to be okay with saying that you're engaged in this for a profit. If an activity shows a profit 3 of the previous 5 years, then it's going to be presumed a trade or business, and the IRS must establish that it's a hobby. That means then the burden of proof becomes on the IRS to say that you're not in a business, you're in a hobby. So if you do not meet those rules, it doesn't mean that you can't be a business, but then what happens is the burden of proof becomes on you. So let's make a few notes regarding this. We have our rules, or I really shouldn't call them rules, but I guess that's what they call them, operational rules, that are on page 5-25 that the IRS is going to look at. And we have 8 rules, 1 through 8, that they're going to be looking at to determine if you are in profit motive versus hobby motive. Also, they have the rule of that if you generate a profit 3 of the 5 years that you're in business, if you have a profit 3 of the 5 years that you're in business, then you're going to be deemed are presumed a trade or business. And then it's 2 of 7 years if we're talking, let's see if we can focus that. There we go. If we are talking horses. So profit 3 of 5 years, you're going to be deemed a trade or business. And then in that case, the IRS would have to prove otherwise. They have the burden of proof. Okay, on the hobby side, if you don't meet the profit rules, let's say if you don't meet the rules, then the taxpayer has the burden of proof if you want to prove and say that you are a business. Other than that, those assumptions will be made. Those assumptions will be made. So let's deal with what if I am deemed to say I have a profit? How does that benefit me? First of all, if you're in business, you're going to file a Schedule C, which is where we report our business income. Losses are going to be allowed, so you get to deduct a loss. You can have a negative net income or a net loss on your Schedule C. And just to reiterate, you want to make sure those rules apply. That is on page 5-25, so make sure you go through those, okay? So basically, Schedule C business, losses are allowed, rules apply, and IRS would have to prove otherwise. IRS, let's say, must prove otherwise. So not a bad position to be in. You would file a Schedule C, and if you end up having a loss, you could take it. Now, if I am deemed to be hobby, and I'm earning income, so you have to report the income. But what's going to happen is the deductions are going to be limited. The deductions are going to be limited to the income. And therefore, no loss allowed. No loss is going to be allowed on that one. And the way you report this is that you don't file a Schedule C because you're not a business. Income is going to go under other income on your 1040. So on the front of the 1040, you have a line that says other income, line 21, and that's where you're going to list your other income for your hobby. And then the expenses are going to be deductible on Schedule A. Okay? On Schedule A, if you have taxes and interest, they're just deductible under the tax and interest section of Schedule A. Okay? And then all the other expenses are going to be deductible as miscellaneous expenses. And they are going to be subject to the 2% limitation of AGI. 2% of AGI. Okay, so your expenses are going to be also have to be deducted in this order. So these expenses, similar to what we had when we had our rental income, where you had to take the taxes and interest first, and then all your other expenses, and then any depreciation that you may have. And remember, these are going to be limited to your income. So if I have income of $5,000, I can only deduct $5,000 worth of expenses, and I have to deduct them in that particular order. I had to deduct them in that particular order. Let's look at the example at the bottom of page 5-25. Fred is the president of a bank. He decides that he wants to be a famous winemaker. He has the following expenses related to his activity. Depreciation on winemaking equipment, $2,000. Personal property tax on equipment, $2,500. And winemaking supplies of $4,600. During the year, Fred sells 200 cases of wine for $7,500. Now remember, he's a bank president, so this is kind of a hobby. If the activity is not a hobby, then Fred could take a loss. He would take all the expenses. He would take the $7,500 minus the $2,000 for depreciation, minus the $2,500 for the property tax on the equipment, and then minus the winemaking supplies. And so he would end up with a loss of $1,600. He could take the whole loss, Schedule C, assuming that it's not a hobby. You know, even though he's a banker, there may be those rules and that he can prove that he's still in this for business. However, if the activity is deemed to be a hobby, the deductions are going to be limited, okay, to where we're going to first start off by taking the $2,500 of the taxes. And actually, let's do that calculation. Let's go ahead and do that. He had income of, this is our example on page 5-25. We're going to start off, he has income of $7,500, and remember that's going to go on schedule on the front of your 1040. That's going to go on the front of your 1040. And then from that, we're going to start off and we're going to deduct the taxes and the interest first, which the taxes and the interest, we had taxes of $2,500. And that gets us to $5,000 left. And then we're going to deduct the supplies, the other expenses, which in this case is his supplies. And he had supplies of $4,600. And that leaves us $400 of depreciation that we could take. So he would end up taking these on Schedule A under that section. These two items would be miscellaneous deductions subject to 2% of his AGI. Subject to 2% of his AGI. So that is how we deal with hobby versus profit motive activities and how we would make those deductions Okay? Finally, on page 5-26, we get to our educational incentives. We get to educational incentives, and they discuss a couple of our number of programs in this area. A number of programs in this area that we want to look at. Okay? You should have a handout where we continue to take notes. First of all, they start off with qualified tuition programs. QTPs are 529 plans. Okay? These are tuition credits. Tuition credits are certificates, okay? Tuition credits are certificates, okay, for contributions that we make to different programs, okay? In this, there's no limit on the contributions, but they are also non-deductible. So no limit on our contributions. They're not non-deductible. They're non-deductible. So if you look here, they talk about that. These are for qualified higher education expenses. So we're talking about our tuition, fees, books, supplies, equipment, and they make a point of saying reasonable. They don't define reasonable, but they make a point of saying reasonable room and board. Reasonable room and board expenses. So they make a point to indicate that those are reasonable room and board expenses. So I can make contributions. There's no limit. but they're non-deductible contributions. And now the distributions that I take out are going to be generally, there's always some exceptions, they generally are not going to be taxable. Of course, as long as I am taking them out for qualified higher education expenses, just as long as I'm taking them out for that purpose. Okay, a lot of these are set up, as they say, to buy in-kind tuition credits or certificates for qualified higher education expenses, to contribute to an account, a specific account established to meet these qualified education expenses. So we have these accounts set up, and a lot of state governments may set them up, or private institutions. There's a different number of ways in which we do these. In addition to taxpayers being allowed reasonable room and board costs, they're going to be subject to certain limitations. The earnings portion of the distributions that we take out that is not used for education, because remember, I put them in, technically it's growing tax-free, so that when I take the money out, as long as I use it for education purposes, it's not going to be taxable to me. But if I take it out and I don't use it for education purposes, it's going to be subject to a 10% penalty. Okay, it's going to be subject to a 10% penalty if I, and that's only on the earnings portion, because that's what you're getting tax-free. It's not going to be subject to that on your own money that you put in that you didn't get a deduction for. So it's only on the earnings portion that's going to be subject to that 10% withdrawal where you didn't use it for education purposes. We also have Hope and Lifetime Learning Credits, which we will deal with in our credits chapter. But you want to make sure that you're not getting double benefit for these education. So let's say I put money in my 529 plan for my child, and it's been in there for a number of years. It's growing tax-free, and so I take it out, and I don't have to pay tax on it, and I pay for the education. And then I turn around and say, okay, this money that I took out, I want to claim a Hope and Lifetime Learning Credit on, okay? And so we can still get that, but we can't get it for the same expenses. So claimed only if we can get the Hope and Lifetime Learning Credit. It can be claimed only if the distributions is not used for the same expenses. For the same expenses. Let's see, they do give us an example. Let's look there on page 5-27. In 2008, Sammy receives $15,000 from a qualified tuition program. He uses the funds to pay for his college tuition and other qualified higher education expenses. Sammy also claims a Hope credit of $1,500 for the year based on the same expenses. For the purposes of the exclusion, then he's going to have to take that $15,000 and reduce it by the $1,500 that he took the Hope credit on. So if you're going to take that $15,000 out and you're going to claim a Hope credit on a portion of that, you're going to have to reduce that amount by the $1,500. So just be aware of that. You can't claim it on the same expenses. They say it has to be on different expenses. It has to be in different. Now, for some reason, if the distribution that you get from your plan exceeds the expenses, okay, if you take out more than the expenses, then what you want to do is you want to allocate the expenses. You want to allocate the expenses among the distributions. And then determine the excludable amount. Because in that case, since you didn't use it all, there is a portion of it, not all of it will be excludable because you didn't use it all for education. Not all of it will be excludable. Let's see if they give us a decent example here on top of page 527. Bill has an AGI of 275. He has 2 children. He chooses to contribute $9,000. He's allowed to contribute, that's on his limit. They don't give us an example, but just know in that case, all of it may not be excludable. I thought they gave us a pretty good example on that, but they do not. Okay, so educational qualified tuition plans, like I said, 529 plans. A lot of states on those 529 plans. Make a note, there are nearly $90 billion invested in the increasingly popular Section 529 qualified tuition program across the country. The plans offered by different states vary significantly, and it's possible for a taxpayer to invest in the plan of a state other than the state that they live in. Okay, they have a website there, collegesaving.org and savingforcollege.com. I have 529 plans set up, and with the economy, my kids' plan did lose a significant amount of money, but that's okay. It'll be a long time before they go to school, so we have some time to recoup that amount of money that was lost in those plans. Okay, educational savings account, education IRAs. Let's look at the IRAs that they have there. Okay. Actually, let's go back. They do. I thought they had a good example. I'm sorry. They do have a good example on when we have those excess. Let's look at the top of page 5-28. Joe, who is single, would like to contribute $2,000. Nah, that's still not what I'm looking for. I'm sorry. That's still something else. But anyway, let's look at our educational savings. Now, here we're going to have a limit on the contributions. Here we're going to have a limit on the contributions. The maximum amount that you can contribute is $2,000 per year per beneficiary. So in our 529 plan, no limit, and we'll deal with that. But here, there's a maximum of $2,000 per year per beneficiary that we can take. Those contributions are not deductible. So even though we're limited, we still can't take a deduction for them. And then as far as that maximum, there's going to be some limitations. You're going to be subject to some limits, some income limits, okay? Our income limits is we have AGI, where we phase out that, and we're going to look at an example. That's the example I was trying to read. But our AGI amounts that we're looking at is $95,000 to $110,000, and that's going to limit these contributions that I can make for a single person, and then $190,000 to $220,000 for joint returns. And so given that, I may not get to contribute the full $2,000. I may not get to contribute the full $2,000. And then beneficiaries of 18 years in order, it should be for college age children. So contributions cannot be made on educational savings accounts after they become 18 years old. So after that, you cannot make any contributions. At that point, they figure they should be headed to college. You should be making distributions at that time. In any year payments made for tuition. So if for some reason maybe they go early, maybe they go at their 17 and you draw money out in order to pay tuition. Any years that you're making a payment for tuition, then you cannot also make any contributions. Okay, so you can't make a contribution in those years either. So let's look at that calculation that I was determined to read here on page 528, where we have Joe, who is single, would like to contribute $2,000 to an educational savings account for his 12-year-old son. However, his AGI is 105, so his contribution is limited to $667. And what we do is he He's single, and the upper limit for a single person is 110 minus his AGI. So that means he had 5,000 still within his range. And you divide it by 15. You divide it by 15 because there is 15,000 between the range. Between 95,000 and 110, there's a difference of 15,000. So you would divide it by that. You would divide it by that. For married, filing jointly, there's a difference in range of 30,000. So in that case, you would divide it by the 30,000. Then you multiply that times 2,000. And so therefore, his limitation would be $667 that he can make to that plan, that he can make to that plan. So this educational savings account, our IRAs, they have a limit of $2,000 when there was no income limit on the amount of contributions for a qualified tuition program or a 529 plan. So also they make a note here for page 528 under the tax break for parents with income above the allowable limit. So let's say I'm above the allowable limits in this case. A gift may be made to a child, and the contribution may be made to an educational savings account by the child. There is no requirement that a contributor have earned income. So there is have earned income as for an IRA. So keep that in mind. There's a way you can contribute a gift, and you know, gift taxes, or I think gifts for your children, you can gifts up to $100,000. So you can do it through a gift. You can do it through a gift. Okay, and so the amounts are distributions from the plan are going to be tax-free as long as they're used for education, So the distributions from the plan are going to be tax-free as long as they are used for education. Okay, so if they're used for education, then it should be fine. It should be fine. Those qualifying expenses are going to be tuition, fees, books, supplies, and under supplies we're considering computers. Maybe you buy a new computer. And then the interesting thing about this is all this is for private, also for private elementary and secondary school. So it's not just for higher education. You can save for your child to go to private or elementary or secondary school, as well, of course, college. Okay, so that's the attractive. A lot of kids go to private elementaries and secondary schools, and so you can begin at birth making contributions to these accounts, so that at the time it's time for you to pray for private schools, that you have that amount to do that. Also, you can take room and board. Room and board can be considered in these expenses as well. If a student's course load is at least 50%, meaning he needs to be at least a half-time load, take at least a half-time load. Now, if the distributions exceed the expenses, then you want to take your qualified education expenses, you know, the actual expenses, divided by the total distribution, which the distribution is going to be more than your expenses. That's why we're doing the calculation. Then you want to multiply it times the earnings, and that's going to represent the amount that you can exclude. You can use the same calculation for when you're dealing with the 529 plans as well. So you want to take the qualified, because you're going to exclude earnings based on a percentage of the qualified education expenses, based on the percentage of the qualified education expenses. So here's my example. Amy receives a $2,000 distribution from her education savings account. She uses $1,800 to pay for qualified education expenses. On the date of the distributions, Amy's account balance was $5,000, $3,000 of which are her contributions and the other $2,000 being earnings. Because 60%, $3,000 of $500 of her account balance represents her own contributions. She had $5,000 in it. $3,000 was her own. $2,000 was earnings. Of her account balance represents contributions. $1,200, 60% of the $2,000 of this distribution is tax-free for capital, return of capital, and the other $800 is her distribution of earnings. So therefore, we want to take the $1,800 divided by 2,000 and times 800, which is the earnings portion of that $2,000 she took out, and therefore 720 of it would be excludable. Would be excludable, for therefore only $80 she would have to pay as tax. She would only have to pay as tax. Okay, so that is your educational IRAs. We looked at 529 plans. We looked at IRAs. And then the last one is higher education expense deductions. And these are allowed above the line. They call them above the line items. So here is our schedule, our 1040, our tax return. Here's our taxable income. And then line 34, which you can't read, but it says tuition and fees deductions. Attach a form 8917. So these are our higher education expense deductions that we can deduct above the line deductions for qualified tuition and related expenses. Okay, the deduction will be allowed for those qualified tuition and related expenses for enrollment, as they say, in an institution of higher education. So these are only higher education expenses. These are only higher education expenses. Okay, so these are, as I said, a deduction. These are a deduction for AGI. Okay, qualified expenses are going to be tuition and related expenses. And for college, okay, or higher education. So we can't deduct secondary. I'm not spelling today. Okay. Now the expenses that we take for this tuition and fees deduction, these expenses have to be reduced by any excludable interest on higher education any higher education bonds, okay, or any excludable distributions from a qualified plan. Or some type of savings account. So basically you have to consider all these other things we just spoke of, and then they very well may reduce these expenses that we can take for above the line items. Then we have some also income limitations, but these are just deductions, okay? These are just deductions in amount. There's a $4,000. Okay, there's a $4,000 versus a $2,000 deduction that you can take. There's a $4,000 versus a $2,000 deduction that you can take. And it's based on your AGI. It's based on your AGI. And so if you are single and your AGI is below $65,000, then you can get $4,000. If you're married and your AGI is below $130,000, then the maximum amount of your deduction is going to be $4,000. So I can get a max of $4,000 if I meet these income limitations. And then if I am single and my AGI is between $65,000 and $80,000, then I'm going to be limited to $2,000. And if I'm married, filing jointly, and my AGI is between $130,000 and $160,000, then I'll get $2,000. Anything over that, I'm not going to be able to get any of that. Anything over that, I'm not going to be able to get any of that. So keep in mind that these items are going to be a deduction for AGI to get to your AGI, and then there's some $4,000 and $2,000 limits on the amount of which I can take on the limit, and then you're going to have to reduce those expenses by some other items. Okay, so that finally finishes up chapter 5 for us. We've done a number of problems. By now you should hopefully be almost complete doing your multiple choice for this chapter. We've done a number of problems and exercises. So what we want to do is you want to make sure you get those multiple choice to me. I believe the next session we're going to do a tax return together, kind of at a stopping point before we deal with our credits and some other things that I want to cover in this particular basic income tax class. So do the multiple choice, get those into me, and in the next class we're going to work on some tax return problems and some calculations and calculating tax and going over some basic things. And then in the sessions after that, we'll pick up with credits. So we're going to spend the next session just really doing tax returns, looking at some forms and going through some things to get you some clear understanding on a lot of the things that we've covered up to this point, so that you can be clear on how to prepare a tax return up to this point. And then we will begin to deal with Chapter 6, some credits. And some things in Chapter 4, we skipped Chapter 4, but there's some things I want to pick up and cover in there. And so that's it. Thank you.